So I'd like to, on behalf of the Punjabi Chamber of Commerce, I'd like to welcome you. And we're doing this in association with our good friends at SALDEF, which is the Sikh American Legal Defense and Education Fund, and our longstanding good friends at the Asian Indian Chamber of Commerce. So I'd like to welcome members of all three associations to this webinar. And as you know, the COVID-19 pandemic has affected us all, and we decided that it would be very good for all of our members to know about government enforcement and the PPP loan programs and the labor laws as well. So I welcome all of you to this webinar, and just if I could just take a minute to describe what our chamber is, and you guys, and also give you some introductions of the members, of the leaders for the other two groups thereafter. So the Punjabi Chamber is a free chamber. It's a global chamber which is basically unites the world Indian Punjabi diaspora through a platform that promotes cooperation, networking, and it's also provides education and mentorship and other support activities for its members. We are free, we're supported only through the support of our sponsors, and that's the only way we can go forward. And we appreciate all our sponsors. And so, for example, our first, another part of our program is that we unite business with charitable functions. So recently we just formed the Punjabi Chamber Foundation, and we had a wonderful raise where we raised about $35,000 for COVID relief, and we were able to provide much needed meals, PPEs, and now we're doing ration kits, we call them, even in India and in the US. So I want to thank everybody who's contributed. We were able to raise about $35,000, like I said, right? So without further ado, I'd like to thank our sponsors in particular. It's Mass Mutual, New Jersey and New York, primarily Rekha Trivedi and Meena Chib. We have Biz2 Credit, who's one of our sponsors, and Ramit and Rohit Arora from that group, we thank you. We have New York Life, Rohin Honda, the executive partner. Thank you very much for supporting us. And then my good friend from Vital Global Communications, Praveen Andapali. Thank you so much for supporting this webinar. And as I said, without you guys, it wouldn't have been possible. So at this point, I'd like to introduce Priti Pandya Patel from the Asian Indian Chamber of Commerce. And after her, Ms. Kiran Gill from SALDEF, the Sikh American Legal Defense and Education Fund. Well, I asked you guys to talk about your organizations briefly. Thank you. Priti? Kiran, why don't you go ahead first then?
Thank you so much, Gary. So SALDEF is the Sikh American Legal Defense and Education Fund. As Gary mentioned, I'm Kiran Gill, I'm the Executive Director, and we're so pleased to partner with the Punjabi Chamber of Commerce on this event today. SALDEF is a national Sikh American media policy and education organization, and our mission is to empower Sikh Americans by building dialogue, deepening understanding, promoting civic and political participation, and upholding social justice and religious freedom for all Americans. And again, I think this is such an important topic, and we're very pleased to be partnering on this webinar today.
Okay. Priti? Can you say a few words? Well, I will say a few words for Priti if she doesn't, Priti Pandya Patel is the president of the Asian Indian Chamber of Commerce. And the AICC is one of the oldest Indian chambers, South Indian chambers around. It's been around for 25 years. And it's a vital part of our community, especially here in Central Jersey. And I want to thank the folks at AICC for co-sponsoring this webinar. So I'd like to just get started then. Meantime, I'd like to introduce our moderator, and who's one of our leaders at PCC, and Miss Rippi Karda. And just bear with me. And Rippi is an associate general counsel at Verizon Communications, Inc., and she handles contracts for sourcing legal involving HR benefits plans, consulting, contact centers, contingent workforce, recruiting, advertising agencies, and supplier diversity. Prior to entering the technology industry, she worked at several pharmaceutical and biomedical companies. She is a frequent speaker in the legal industry and on corporate matters, and more importantly to us, she is a wonderful leader for us at PCC. Thank you. Thank you, Rippi.
Well, thank you, Gary, for the kind introduction and the opportunity to moderate this substantive, timely panel presentation today. I want to thank everybody for joining us, and we do have an amazing dynamic lineup of subject matter experts that are going to share their insights that are so relevant to today's environmental climate, today's business climate, and we'll just take care of a couple of housekeeping issues to start with. Our presentation will be recorded and available afterwards. The panelists have very graciously offered to be available for your questions afterwards. We will be supplying their contact information, so feel free to follow up directly with each of them, or collectively all of them. And lastly, all the views expressed by the panelists as well as myself today represent our own and are not reflective of any of our respective employers. And I'm going to go ahead and start with our first speaker. I'm going to introduce him really quickly. His name is Sandeep Chandi, and he is an associate with Pasricha Patel, where, of course, Gary is a named partner. His primary focus is in the business, commercial, and technology spaces, and he regularly represents startups and emerging companies throughout their life cycle and advises them on a broad range of legal and business issues related to their governance, day-to-day affairs, and corporate transactions that include financings, M&A deals, and strategic partnerships. So in summary, if it involves money, Sandeep is your go-to guy. And after Sandeep, we have the pleasure of having with us again, Vik Jaitly. He's an associate in the Philadelphia office of Ogletree and Deakins, and he represents employers in federal and state courts with respect to employment and labor-related issues that relate to compliance with federal and state employment statutes, non-compete, solicitation and non-disclosure agreements, as well as discrimination and harassment matters, as well as wage and hour compliance issues. He assists his clients with employment hiring, compensation, and termination practices, complaints and investigations, and also, unfortunately, reduction in force issues. Really seasoned person. We're really happy to have you here today, and I know that this is not your first time being a panelist for PCC, so we do appreciate your repeat loyalty and dedication to the organization. And lastly, we're really honored to have Sonny Carpenter with us. He is a former federal prosecutor and now a member of Baker Hostetler's National White Collar Investigations and Security Enforcement and Litigation Team. I know that's so much. He must have such a busy schedule, and yet he's made the time for us today. His practice focuses on investigations and regulatory compliance matters in the area of healthcare, antitrust, corruption, and money laundering. all the good stuff. He represents clients in investigations by the Department of Justice, the SEC, and state attorney general offices. He's known for helping his clients develop and strengthen their compliance with the law to actually prevent government investigations, but is available to deal with those as well. So I'm going to turn it over to Sandeep to go ahead and start, and if you can direct your attention to Sandeep now.
Thank you, Rippi, for the kind introduction. Is my mic on? Are we good? Okay. Thanks, Rippi. Good afternoon, everyone. Thanks for joining. I have a lot of dense content to get through, so I'm going to get started quickly. In a nutshell, P3 loans, and when I say P3, I'm referring to the Payroll Protection Program, but P3 loans provide relief in the form of federal government paying for certain costs to small businesses over an 8-week period. The loan is forgiven to the extent that the business uses the loan for covered costs, which I'll go into more detail over that 8-week period. There's some issues with the P3 loan program, of course. It's a massive program that was rolled out very, very quickly with minimal supervision and review of the applications itself. The primary objective of the program was to inject a large amount of money into the economy quickly. Undoubtedly, some of the businesses will take improper advantages of the loan program itself, and Sunny can speak to this in more detail, but 2021 will likely be a year of enforcement actions aimed at those engaging in fraud over the P3 loan program. Given how quickly this was rolled out, there will inevitably be some accidental uses for some of the people that don't follow the rules and find themselves kind of lumped together with those who are actually committing fraud. So just upfront, borrowers should protect themselves from liability by ensuring P3 funds are used in the authorized manner. As such, this segment of the webinar will focus primarily on what to do after you've received the loans to avoid such pitfalls. Again, the basic idea behind the use of the P3 proceeds is simple. Borrowers should use the money quickly, mostly to pay employees, and should bring their workforce levels back to pre-pandemic levels, if possible. And you'll see in some of the examples, for a lot of the industries, it's just not possible. It may be a challenge with restaurants or schools, for example. In any event, we're going to focus primarily on what to do after you receive the loan, and the idea is that you'll be able to use the money in the authorized fashion. Karen, if you can please switch to the next slide. So you have your loan, now what? What can the P3 loan proceeds be used for? So on the screen, you'll see a breakdown, a very brief breakdown of what they actually can be used for. Under the CARES Act, yes, that one right there. Under the CARES Act, the borrower can use the P3 proceeds to pay any of the following costs, payroll costs as they're defined. I'll quickly go through them. Salaries and wages capped at $100,000 annualized, payment for vacation, parental, family, medical leave or sick leave, severance pay, healthcare benefits, insurance premiums, retirement benefits, and state and local taxes. And remember, it does not include federal taxes, so FICA. There are some non-payroll costs that you can also spend the proceeds on. That includes interest on any debt or mortgage obligations that existed, and this is the key, before February 15, 2020, rent arising under lease agreements in effect before February 15, 2020, and utility payments such as gas, water, transportation, and etc. The statute, this is where it gets a little tricky. The statute itself does not require any specific allocation of the proceeds. However, the interim rules, the multiple interim rules that have been released and all subsequent guidance really requires borrowers to spend at least 75% of the loan on payroll costs. The borrower themselves, you as a borrower, you're responsible for documenting the use of the proceeds in order to determine the amount of forgiveness, which we can get into later. But if a borrower uses the loan proceeds for unauthorized purposes, the borrower will be required to repay those amounts and potentially could be subject to additional charges from the SBA for knowingly violating or misappropriating those funds, which we'll also get into later. As you all know, P3 loans are made without collateral or personal liability, or I should say guarantee. However, if you do use the proceeds in an unauthorized fashion, you as a shareholder, member, or partner can be liable, thereby activating that personal guarantee. So we want to avoid that. And hopefully this webinar will guide you through that and navigate you to avoiding those pitfalls. So the CARES Act also provides that the loan proceeds can be used for any allowable use, which other 7A loans can be applied under the SBA. And those uses I won't get into in too much detail, but they include inventory, supplies, working capital. However, that's the general rule. The P3 rules list only as permitted those detailed in the slide above. And one actually additional item I would like to add in there, for those that also received EIDL loan, that would be a required portion that would need to be refinanced with the P3 loan. So anyways, generally, the CARES Act permits P3 loans to be applied towards other allowable expenses. However, they do require 75% be used and applied towards payroll costs. It kind of remains unclear whether the SBA is restricting permitted uses to only those expressly listed in the slide above. So we await further guidance on that, but note that the slide is, some of the items, even with the non-payroll costs, they're not forgiveness eligible, which I'll get into a little more detail. So as you can see, this material is a little dense, and I'm gonna try and help you, guide you through this, but my interpretation of it is a conservative approach, and as the threshold matter, I think everyone should be aiming to use their proceeds at least 75% on payroll costs. And if you can't, then there could be other pitfalls that we need to avoid, and we can try to maximize those usages. But as a threshold matter, 75% should be used for payroll. Sandeep, and also yeah, go ahead. Sorry. Yeah, I was just going to say.
Go ahead, finish.
No problem. It's pretty apparent from just the legislative intent that the naming of the program itself is Payroll Protection Program. So just being reasonable and looking at the intent that the legislation had itself, it is really to pay those costs.
So I had a question for you, because it involves this $100,000 per employee. Does that cap apply to non-cash benefits as well?
Yeah, so that's a good question. No, the exclusion itself, it does not apply to non-cash benefits. The compensation in excess, any non-cash benefit compensation in excess of 100,000 can be used to apply towards these costs. So it's not subject to that cap. And also those calculations should have been factored into the loan amount calculation itself. So you would have received 2.5 times that when you did your calculation.
So you mentioned the rent earlier for our smaller to mid-sized business owners. I think it's a common question that's come up before, that what does that rent include? Can we pay taxes from it? How about common areas and maintenance expenses, property insurance, possibly other pass-through costs? Can they be covered through that as well?
So it's unclear at this point. We still require further guidance, but my interpretation is, to the extent CAM and taxes are embedded in your rent payments, there should be no question that they are eligible costs. But separately, if they're stated separately and escalations are separate, there's really no clear answer, unfortunately. I would like to add one other thing, since I didn't mention rent. Further guidance have told us that this also includes personal property rentals. So if you're in a restaurant and you have a dishwasher that you're renting out, you could potentially use those payments as well.
Okay, thank you.
No problem. Next slide, please. So now we've covered the proceeds, the use of the proceeds itself. Now you need to use those proceeds within this 8-week period. And what's happening now is the recent application that was released for the loan forgiveness that gave us some clarity and further guidance has given us an alternative cover period. However, the initial period is 8 weeks from the date you received your loan in your bank account. So most people have been using that 8-week period. We'll see some issues that have been ongoing, especially with the payroll cycles. But the application itself now provides that borrowers must submit and maintain all forgiveness requests and spend all these proceeds within this 8-week period. So to access eligibility, the lender will evaluate your use of proceeds during either one of the 8-week periods that you choose. And this is an option that the borrower has, depending on just what's convenient for them. So it's really more of a convenience option than anything else. So either you can choose an 8-week period from the date you received your loan, or if it is more convenient to align with your payroll schedule, the alternative 8-week period that begins on the first day of your first payroll period following the loan disbursement. So I know that's a mouthful to understand, but essentially you can choose one or the other. If your payroll period doesn't match up exactly with the date you received your loan, then you can opt for that alternative cover period that begins later. But it's important to note that alternative cover period is only for payroll costs. It does not apply to non-payroll costs. So that's one thing probably that's important to note. But if you do, for some reason, a lot of non-seasonal employees, especially with the new guidance, they may have had multiple disbursements. So it's important to note that the first date of the disbursement is where that 8 weeks starts from. So if you ramped up your loan amount and had a second disbursement that came in at a later date, that date doesn't matter, it's irrelevant. It's either the first date or the date of your first pay cycle.
So Sandeep, if I can ask just to clarify, because there's a lot of different nuances and I know you're giving a more general overview here, but can the borrower continue to use those PPP loan proceeds after the 8-week forgiveness period expires, or is it mandatory that you have to do it during that time frame?
The technical answer is yes. While the loan forgiveness amount is based on certain expenses paid in the first 8 weeks following the distribution, the borrower can continue to use any balance that they may have after that time. Now, there's another clarification I would like to make. I'm sure people are seeing this June 30th date floating around as a cutoff, but we believe the CARES Act itself, in the CARES Act itself, that June 30th cutoff was only for the deadline to make the loans. So we're hoping they'll clarify that. But yes, they can continue using those proceeds, but it's at the risk of paying them back, of course. So loan forgiveness. So this is the crux of it. The CARES Act itself requires you to seek forgiveness. So it's not automatic. That I just want to put that out there. It's not automatic. You have to apply for this. And in order to apply for it, you have to go through your bank, and there's going to be further guidance on this. But luckily for us today, we have the loan forgiveness application that was released. So we have some guidance. Otherwise, we were left in the dark a few weeks ago. But it's not automatic. You must apply for it. And generally, to cover what the mechanics are, the lender has to make a decision within 60 days after you apply for it. And people ask, when should I apply for it? I think you should apply for it right after the 8-week period expires, as soon as possible, because that's the eligible period. So depending on what period you choose, apply for it the day after, make sure your documents are in order. Speaking about documents, the bank and the SBA will require documentation. So you'll need to verify the number of full-time equivalent employees, their pay rates. You'll need to document payments of mortgage and rental obligations and utilities. The SBA may issue additional guidance on the form of this application and documentation required, but for now, just remember, you need to document everything you spend the proceeds on. I think also, as a practical matter, if you can maybe use a separate bank account to disperse those proceeds, it may be helpful. But under the P3 rules, the entire principal amount, just going back into the forgiveness, the entire principal amount and any accrued interest, although it doesn't specifically say that anywhere, is eligible for forgiveness if you applied that towards forgiveness eligible uses, which we'll go into, but it's essentially you're using the proceeds in an authorized fashion. So the form, the forgiveness form itself, it's called the form, SBA form 3508, provides that the borrower is eligible for forgiveness in the amount of lesser of. So although it can be to the extent of your principal and all accrued interest, there's reduction factors that come into play, but it's either the full amount or the sum of all forgiveness eligible costs. So if you're not able to spend the proceeds within that 8-week period, then it's only capped at that, of course. That seems pretty logical. Or if your payroll costs, since they have this, we'll go into the 75% rule. If your payroll cost during the covered period is less than the 75%, then it'll be that cost divided by 0.75. So essentially you're capped one way or the other. The maximum is the loan amount itself with the accrued interest. So what's the forgiveness eligible cost? It's basically payroll costs, interest payments, and mortgage existing before February 15th, rent before February 15th, utilities before February 15th. That's in each case incurred and paid during that cover period. So you have to remember that not more than 25% of the forgiven amount can be attributable to non-payroll costs. So that's a threshold matter. If you attribute more than that, then forgiveness takes a kicker. Payroll costs are considered paid. There's an issue with incurred and paid. A lot of people have this question about, you know, what if I incurred it before the 8-week period but paid it during the 8-week period? And it's a whole concept of cash and accrual basis. But payroll costs are considered paid on the day that paychecks are distributed, or the borrower originates ACH credit transactions. Payroll costs are considered incurred on the day that employees' pay is earned. So hopefully that'll draw the difference out. But payroll costs are considered paid when you pay them the check, and they're considered earned on the day incurred, excuse me, on the day they're earned. Eligible non-payroll costs must be paid or incurred during the cover period and paid on or before the regular billing date itself. So this is all logistics. It's all with the timing. You need to make sure that you're spending your money wisely within that 8-week period, and you're documenting each and everything that you're spending, and you know for what it's allocated for what period it's allocated for. So the only guidance we have is on this, that it has to be paid and incurred. And hopefully the SB will issue further guidance on this, but the phrase itself that's used in the statute is still ambiguous as of today, and drives most of the loan strategies, most of the borrowers crazy because they can't strategize. But all we can do is be aware as to how all of this works and how it affects our forgiveness aspect of it. So in sum, additional guidance is needed to better understand how to properly compute the costs incurred and payments made when determining the forgiveness amounts under the P3 loans. But just remember, it's accrual or cash basis, and what the answer is depends on what the borrower's normal methods of accounting for tax purposes are. So hopefully that'll clarify some of the rental obligation questions that borrowers may have had, or mortgage questions that borrowers may have had.
Sandeep, I'm just going to really quickly, I thank you so much to the audience for being so engaged and asking amazing questions. And as you can see, as Sandeep is progressing with his portion of the presentation, a lot of your questions are being answered, but we are going to take the questions at the very end and have our panelists answer them at the end. So if you can kindly, instead of raising your hand during the presentation, if you could type them into the Q&A portion at the bottom, there's an icon. If you can click on that and put the questions in there, we can answer them at the end. But I do want to take this opportunity, as I'm interrupting you anyway, Sandeep, can you tell us what documentation will borrowers need to provide to their lenders in order to get this loan forgiveness?
Yeah, sure. I mean, I think some of the standard stuff is just documenting all your full-time equivalent employees on payroll. A lot of people will have payroll companies and 941s, which we can pull down and use as well. And a lot of these payroll companies have this feature. They have like a separate COVID-19 tab that you could pull down. You just have to make sure that the time periods again that I went over. You know what? I'll pause for a second. Kieran, can you go to the next slide? I just realized we didn't switch the slide.
So while she's doing that, can I ask you
There
a
we go.
follow-up? Oh, sorry, go ahead, finish.
Yeah, sorry. No, I just figured it's useful to have this information on the screen at this point. So the documentation itself is just verifying the number of full-time equivalent employees that are on payroll, along with the pay rates. And you can usually pull, if you have a payroll service, you can usually pull down that information from there. Proper tax filings, state income, payroll, unemployment filings, anything that covers expenses during that period should be well documented. Documentation verifying the payments on your mortgage, rent payments, utilities, and as long as they have that period for which that invoice covers.
Can you then just tell us really quickly how FTEs are calculated? Are they using the ACA method, or do you just take all the hours and divide it by 30 or 40?
So there's two methods into how full-time equivalent employees are calculated. I can go into detail with that a little later, but for now, what we should understand is essentially the latest method is anyone that is working 40 hours is equivalent to one full-time equivalent employee. Anyone that's working less than 40 hours, you take as a half. Okay, so that's the method we can use. So just to recap, because this slide wasn't on the screen initially, forgiveness on the right-hand side, forgiveness amounts are lesser of those 3 bulleted points. And then forgiveness eligible costs really match up with the authorized use of proceeds.
And I'll just ask one more question about the loan proceeds. So can you save them for a rainy day? That's the first part of it. And number 2, if payroll is due on the day that you receive the funds, can you use those PPP funds to pay the employees?
So the question with regards to can you save them on a rainy day, I think a lot of people will have this question, and a lot of industries such as restaurants are open, but they're takeout only for the most part. Schools and other industries, they're on lockdown or they can't open because of government mandated shutdowns. I think we all go back to the intention of the loan itself. The purpose of the program was to inject money quickly into the economy, primarily to pay employees. So it does provide an opportunity for complete forgiveness based on just that. So taking that into consideration, those portions of loans that are not spent quickly enough or for the right purposes must be repaid over the 2 years. So that's a general rule, right? If you don't use it, you pay it back. But the idea is that these amounts should be small. Anything that's remaining, so quote unquote for your rainy day, should be a smaller amount. It shouldn't be the entire loan proceed itself. If the borrower does use the P3 funds for any unauthorized purpose, the SBA will first direct the borrower to repay those amounts. And if you comply, then hopefully you can avoid any further prosecution. But if you go and knowingly use those funds for unauthorized purposes, so in this situation, you're saving them up for a rainy day and you're not spending a dime, that would, I think being reasonable, my takeaway is that would be an authorized purpose, because the keyword is knowingly. You're knowingly hoarding that money, you're pocketing it until some other moment that you can use it for, where the intent was clearly to use it for payroll. I think the borrower will be subject to additional liability, such as fraud and include criminal and civil penalties. And I think probably most importantly, the corporate veil is pierced. So the personal exposure that you didn't have initially in the loan program, is no longer there now. You will have personal exposure. And I think with the enforcement action, Sunny can go into that a little further, but that's my take on it.
Okay, that helps.
Okay. So if we can just quickly go to the next slide, I'm going to try and buzz through these things very quickly. So now you have the funds, you're trying to use your money, and you need to maximize your loan forgiveness, because that's at the crux of all this. You know, the most obvious pathway to maximizing loan forgiveness is to maintain payroll and headcount. It's difficult to say what new or clarifying rules will be issued as we transition into the forgiveness phase of the P3 lending. But regardless, borrowers should still be asking, what else should I do to maximize my loan forgiveness? So you go back to the 75% rule, right? Appropriate planning can help, but with lack of guidance, it's difficult, and where it's kind of a moving target every time. But the general purpose is to benefit both of the P3 loans, is to benefit both employees and protect the business themselves. The first obvious way is to make sure you spend at least 75% of the proceeds for payroll costs during that 8-week period. Other 25% can be applied towards, as mentioned before, interest on mortgage, rent, and utilities. But that's the first obvious way, just to make sure you meet that threshold. Under the SBA guidance, it's probably important to note benefits for group healthcare, and I touched on this with your question before, and other retirement contributions are in addition to, and they're not subject to that 100,000 cap. So the second way of increasing or maximizing your loan forgiveness is perhaps just increasing your benefits. So if you as the employer are unable to meet that 75% threshold, maybe consider contributing slightly more during that 8-week period as a special run to your 401ks as a bonus, right? Contribute a little higher percentage to insurance premiums. You know, I just recommend keeping this as a last resort, only because it's not in your ordinary course of business. You're ramping up and inflating for the sake of meeting that threshold. So what I would recommend is this option, leave at the end if you really need to. The second is you can increase your head count, and what I like calling is insourcing. Employers can consider adding headcounts during the cover period. So if you are in that industry that you have work available and people are willing to work for you, hire people. That's the easiest way of ramping this loan forgiveness up. It's, again, it's most attractive to only businesses that have available work, and it gets a little tougher when you're closed or locked down. The insourcing part of it, a lot of our clients, they outsource a lot of some of the technical stuff, accounting, legal, IT. You know, the other option is you can insource, so hire an employee to handle those type of occupations, if you can get to it. The last way is just to raise wages. So that kind of goes into the increasing benefits. You can raise wages temporarily during that period. You could provide hazard pay for employees that are exposed, that are on the front lines and are most exposed, I should say, to the virus. You could perhaps accelerate some bonuses, pay bonuses during that cover period in advance. You know, these are things that really should be left to last resort, though. See what trajectory you're on with spending that 75%. And if you can't, then you have these options available to you to maximize the forgiveness. Next slide, please. This is a little dense. I'm going to try to be as quick as possible, but even if you have calculated your forgiveness, you have everything there. There's reductions in your loan amounts that unfortunately will occur. So reductions in forgiveness amounts are, if any employees who earn 100,000, if their pay is cut by more than 25%, that's the first reason. The second reason is the average number of full-time equivalent employees is reduced during the 8-week period, excluding furloughed workers who refuse reemployment in writing. I can share a safeguard of that with you. and the borrower who fails to meet 75% of the costs. I'm not going to go, Rippi, I'm not going to go into detail on these calculations. Just know that these three are reasons that your loan forgiveness can be reduced. There are detailed calculations that go into it. I have some examples on the slides, but in the interest of time, I'll skip through these examples. But just know that these three reasons are reasons your forgiveness will be reduced.
And this is really, really good information, and there is so much more to it. And I think that once our viewers are able to read it and digest it, and if they do have questions, they can obviously reach out to you afterwards. So thank you so much for this overview. I'll call it an overview.
Yeah, I'm going to skip over, Kieran, if you can skip over the next slide, which shows the decreases and the calculations based on the full-time equivalent employees, and go into one quick example. Yes, so this is just an example I'll cover quickly. So Bob blah blah is a non-seasonal employer whose business is significantly affected by COVID-19. They get $1 million loan through PPP. Assume the company, because it's reduced its headcount, could only spend $600,000 on the payroll costs instead of the required $750,000, which is a 75%. And assume the company spent the remaining $250,000 on non-payroll costs, the total amount eligible for forgiveness would ordinarily be $850,000. So the $600,000 and the $250,000. However, because they didn't meet that threshold, their overall forgiveness is reduced to $800,000. And that's just the calculation by taking 600 and dividing by 0.75. So just to illustrate that example. Next slide, please. The mechanics of forgiveness, I think I went over a lot of these items throughout my webinar, but it's just, you have to submit the application with the lender. The information itself, the supporting documentation needs to verify the full-time employees, the payments that were made, and there are some certifications that the document presented are true and accurate. The amount of forgiveness is requested was used to retain employees. This goes back into that good faith argument and the necessity stuff that they're asking for. And all the payments that we made were made in the cover period. And then the lender just has to come back within 60 days and give you an answer. Next slide, please. So there's some safe harbors that are important to note. There was a safe harbor that was amended multiple times that expired on the 18th, which was to pay back wrongly distributed proceeds. I'm not going to go into detail, but just know that time period has expired. But question 46 that was published last week provided some critical updates on this good faith certification that borrowers had some concern about. Essentially what they're saying is if you together with your affiliates borrowed less than $2 million, you'll automatically be deemed to have made the good faith certification. They're not going to look into it any further. And just know that if you received more than $2 million together with your affiliates, then there will be a review and audit process, and there could be potential citations based on that. They'll SBA will determine if the borrower lacked an adequate basis for the necessity certification. So just know that they're going to pry into it a little more for our purposes here. Let me see if there's any other information that I can provide on this.
I feel like, Sandeep, this information, you could easily make a 2-hour presentation just of this alone, and the amount of content that you've covered so far is substantive and expansive. Are there any highlights that you want to just mention before we move on? Yeah,
let's just wrap this up. If we go to the next slide, just remember the balance. Anything that's not forgiven unforgiven loan balances will be treated as a loan, of course, fully guaranteed by the SBA. You don't have any personal guarantees and there's no collateral. Payment of principal and interest will be deferred for 6 months from the disbursement, and interest will accrue during that deferment period, 2 years at 1%. So just remember that. To me, that's free money, 1%. But just remember that anything that's unforgiven will accrue at 1% over 2 years. And The last concern are just tax considerations. I think just following the bullet points, although the CARES Act excludes the P3 loan from any forgiveness amounts from your ordinary gross income, the IRS recently announced that any expenses that were related to the forgiven amounts of the P3 loan cannot be deducted. So if you think about it, this makes sense. It's just to avoid a double benefit to the borrower. And you know, we live in a system of debits and credits, and that's at the heart of our double entry bookkeeping system as it is. So it's without an equalizing counterpart, it's hard to justify a deduction. So just remember that if you have an amount that's forgiven, anything associated with that forgiven amount, so if you have payroll costs, mortgage payments, rent payments that were forgiven in that tax year in 2020, you cannot deduct those from your expenses.
Okay.
That's all I have.
That's quite a bit, and thank you so much. I want to turn it over to Vik now, because so many of our viewers are worried and concerned, not only from an employer standpoint, from an employee standpoint. How is it going to be for them when they return to work? So Vik, it's all yours.
Thank you, Rippi. I really appreciate it. I'm really happy to be here. Good afternoon, everyone. And as Rippi mentioned, I'm going to change gears a little bit, and we're going to start thinking about, as states begin to lift the stay-at-home orders and businesses plan to reopen their businesses, what you should be thinking about. So first, I'm going to give you a quick update on New Jersey's reopening plan. And I want to be mindful that you may have operations and offices in different states. So you definitely want to look at each city's local orders as far as, shelter in place and what characterizes as essential businesses. And I'm not going to touch on that today. I'm just going to be talking about reopening and what New Jersey has in store and what you should be thinking about. And then I'm going to talk about the safety protocols that you can implement to reduce the transmission of COVID once you reopen your business. And you want to be thinking about things like implementing social distancing protocols, making PPE and other supplies available. You want to inquire about employees' exposure or their vulnerability to COVID, and how to handle sick or exposed employees. So let's jump right into it. Next slide, please. All right, so the first question is, should your business consider reopening? So as you may have heard, Governor Phil Murphy on Monday, he outlined a multi-stage reopening plan for businesses. And currently, he said that, the state is entering stage 1, but didn't offer any timeline for the future stages. And stage 1 really allows for relaxed restrictions on low risk activities, like enjoying parks, beaches, and lakefronts, but then calls for residents to stay at home as much as possible. And you have stage 0, which is the maximum restriction of near lockdown, and then the final stage, which he referred to as a new normal, when potentially a vaccine will be available. So it's going to take some time. It's going to be a process. Again, stage 1 asks residents to maintain strict social distancing practices. Stage 2 will be a broader restart of our economy, and it allows for moderate risk activities with safeguarding. Stage 2 will allow restaurants to provide outdoor dining, certain limited personal care businesses to reopen. And Murphy alluded to the fact that, limited summer camp activities for kids would be reopening, libraries, things of that nature. Stage 3 would include shoppers entering stores, but focusing on limited gatherings with the appropriate safeguards. It would allow for higher contact activities, restarting with, again, significant safeguarding. Workers would be able to return to the workplace with modifications, and we'll talk about what kinds of modifications, and bars and entertainment facilities could operate again in a limited capacity. Now, even after the state gives the green light to reopen, what things should you be considering? Are employees able to work from home even during these stages? And if they are, companies are going to try to, continue that telework policies. And especially if they're able to, and it's going to, prevent, commuting, more contact or less contact with other workers or customers. That's all a good thing. The more contact you have with coworkers and customers, the more safeguards you're going to want to implement. As of this Friday, New Jersey will officially be in stage 1, which is, again, the relaxed restrictions on low risk activities. Now, as the economy begins to reopen, what should we be thinking about? Employees will be concerned about workplace safety, right? And you may find that employees, begin to complain. They'll have issues. Some of them, and we'll talk about this later, will say, I don't want to come into work. But we, as employers, we want to make sure that we do what we can to implement these protocols to ensure that we are operating in a safe manner. Next slide, please. So what does that look like? First thing, social distancing protocols. Social distancing means avoiding large gatherings and maintaining distance. And that's approximately 6 feet or 2 meters from others when possible. So you want to, especially in like break rooms and cafeterias and conference rooms, you want to make sure that if people are doing these gatherings, and only if they're essential, they should be maintaining the requisite 6 feet apart. You want to have flexible work sites. So again, as I mentioned earlier, if you can offer telework, you should continue to offer telework. You should try to implement flexible work hours, so you can have staggered shifts. You should have an increased physical space between employees, if possible, based on your office, based on if you have a manufacturing site, whatever you may be operating under. You should have, again, flexible meeting and travel options. So many clients of mine have postponed non-essential meetings, and everything's being conducted via Zoom or other virtual applications. Some companies, are downsizing, to really offer only the essential services that they want to. And then you can have curbside pickup or delivery and other protocols to really reduce the transmission of COVID. Some states and localities have placed limits on the number of individuals allowed to be in a retail location. So you're going to want to look at that and make sure that if it applies to you, that you're adhering to those kinds of rules and laws. And then again, as I mentioned, employers, should be looking at all local orders, closure orders, reopening orders, what have you, just to make sure that they are in compliance. Next slide, please. So as I mentioned earlier, we want to have the PPE supplies available to employees, and that's personal protective equipment. And I'm sure many of you, if not all of you, have heard of this term. And if you offer it to the employees, they're going to utilize these equipment, which is going to help, again, reduce the transmission of COVID. And if you're in an industry that requires a N95 mask, you have to have a written respiratory protection program. You have to provide the training, testing, and other provisions. So be mindful of that. And other things that you can provide with respect to PPE is, non-medical masks. That can be simply cloth face coverings, face shields, disposable gloves, disinfecting wipes, hand sanitizer, paper towels, safety glasses, things of that nature. And something just to note, if an employee comes to you and says, hey, I cannot wear these gloves or wear a mask, you want to make sure that you understand why. The EEOC issued some guidance in April noting that employers can require that employees wear protective gear and observe the infection control practices when they return to work. Now, if an employee needs a reasonable accommodation under the ADA or Title VII, for example, if they have a latex allergy or they need a modified equipment because of religious clothing, the employer has to engage in the interactive process and have that discussion with them and make sure and then provide that accommodation if it doesn't pose an undue hardship. So just look out for that, and you want to be mindful of that. And the next step is, the employers really want to inquire about exposure and vulnerability to COVID-19. So employers should consider whether to institute a temporary practice of making inquiries into a returning employee or new hire's exposure or vulnerability to COVID. Now, one of those hot topics has been temperature checks, and it's been a debate. And that is something that we are advising, and a lot of our clients are instituting policies related to temperature checks.
Vic, can I ask you a question? Like, this is a really hot topic, as you said, and our viewers are asking questions about that. Is that considered a medical examination under the ADA? And what if an employee just refuses to submit to a temperature check? What can an employer really do about that?
So that's a great question. And under normal circumstances, a temperature check would be considered a medical examination by an employer, and pursuant to EEOC, that would be a violation. But however, we're not living under normal circumstances, and under these this pandemic situations, temperature checks are permissible. And the assumption is that you're applying a policy of, taking these temperature checks all across the board. So you can't pick and choose, but if you're applying it to your entire workforce or a particular office, then you're fine to do that. And if an employee refuses to submit to a temperature check, then you're allowed to, for example, to send him or her home. And say, if they're not willing to submit to a temperature check, that potentially is posing an issue or a safety concern to other employees. And based on that, you won't be allowed into the workplace if they won't submit to a temperature check. And another good point on that is, while we're inquiring about whether, certain employees have been exposed to COVID, if they're experiencing certain, COVID-related symptoms, you're permitted to send the employee home, and you want to follow CDC guidelines in, having them, either stay at home or self-quarantine until they are symptom-free, and then they can come back to work. Now, going to how to handle sick or employees who have been exposed. And now, before implementing a recall of your workforce, you should determine how you're going to handle this. Now, some basic steps you want to include are, actively encouraging sick employees to stay home. You want to the extent possible, you want to minimize, face-to-face contact and assign work tasks that allow employees to maintain a distance of at least 6 feet from others. And then you really want to make sure that once send them home, you want to make sure that they're healthy and that they don't return to the workplace until they are better. Next slide, please.
Well, before we go to the next slide, since we are you're about to talk about the symptoms and whatnot, what happens if an employee tests positive for COVID? What steps should the employee take? Like, I understand what you're saying, what steps the employer should take, but what should the employee do? What's incumbent upon them?
So they should, as I mentioned, they should stay home for 14 days, right? That's what the CDC is recommending. And, they should make sure that they social distance themselves from other people, and that requires them to stay home. They should self-monitor themselves for symptoms. For example, check temperatures twice a day, watch for like fever, cough, shortness of breath. And then this is important, where avoid contact with people who are higher risk for severe illness. And obviously there are exceptions to that. From the employer side, you want to, when you do have an employee who does test positive, you want to, one, let fellow employees know that someone has tested positive for COVID. And you should inform those employees, if you can, who have been in direct contact with this particular employee. But you want to remain the identity of the individual, and you want to, make sure that you maintain confidentiality to the extent possible. You're going to want to make sure that the workplace is cleaned. And there are companies providing services out there who are cleaning workplaces, and you want to make sure that you take those steps. All right, next slide, please. All right. Yeah, so these are the symptoms that you want to watch out for. Again, if you're identifying employees who are in the workplace who show any of these symptoms, you want to have a discussion with them. If they are sick, send them home and tell them that they can return once they are better. Next slide. Really important part of all this and implementing these safety protocols is, educating employees, and you want to educate the employees on the safety protocols. It protects themselves and protects others as well. And not only should they be protecting themselves at work, but at home as well. And while we have these reopening orders coming into place, we're still recommending that either you stay at home, you're going to work, but large gatherings are still not permitted right now. So again, stay home if you're sick, maintain the safe distance, frequently wash your hands with soap and water for at least 20 seconds, avoid touching eyes, nose, and mouth with your unwashed hands, covering mouth and nose, cleaning and disinfecting frequently touched objects, things of that nature. And not only is it important to educate employees on the measures they can take to ensure a safe workplace, it's also important that employees be made aware of the special steps that the employer is taking to ensure the workplace safety. Making sure that the adequate safety measures are implemented and again communicated to employees. It's going to be key to maintaining a positive employee relations after resuming operations. And communicating with employees about safety measures implemented will be key to avoiding a work stoppage potentially, and potentially, workers complaining for really they'll have no basis to complain, but I'm sure you will have complaints from employees, and it just really increases that communication.
Vik, I do have a question. In this scenario, we understand when you're sick, you stay home, you quarantine, you protect those in your home as well from potentially being infected. But what happens if employers open up again and it's allowed by the government, and an employee just isn't comfortable? They are just not there. They're worried. And I won't even comment on the reasonableness of their worry or their concern, but they're not currently ill. And they tell the employer that they don't want to come back to work. What can the employer do in that case? What are their options?
So my recommendation there is first to have a conversation with the employee. You want to make sure that you confirm that the employee one, he or she isn't sick, isn't ill, and that they're not high risk. Because we do have employees that need to be protected, and if they are, potentially COVID positive, that they stay home. And if an employee is coming to you and complaining and stating that either I'm high risk of catching COVID, or I am currently ill, and you want to have that conversation with them. If they are ill or high risk, consider giving them an ability to work from home. Place them on unpaid leave status if they're not able to work on via telework policy, but you don't want to terminate an individual because they're sick or because they're high risk. However, if they're not sick and they just have general fears of COVID-19 and not coming into work, after having that discussion with them, you want to communicate with them, or to them, and say, what your expectations are. You expect them to report to work on this date. Here's your schedule, and if they don't, you'll have to terminate their employment. It's a tough conversation to have, but it's something employers have business and operations to run, and it's something that employees need to adhere by.
Okay, thank you. Again, any closing comments before we turn it over to Sunny?
Nope. I just wanted to say, as the states begin to relax the stay-at-home orders, keep in mind about these particular areas, and contact me if anyone has any questions. I'm happy to answer them.
Great, thank you. Sunny, your turn. You've been waiting so patiently.
No, almost fell asleep, but no, just kidding. Thank you all for joining us today, and thank you, Sandeep. Thank you, Vik, for joining me on the panel today. Hope everyone in the audience is staying safe and healthy. And as Rippi mentioned at the beginning, I'm formerly with the government, and now I defend, prevent, and manage crisis situations for clients, and also help defend them in any sort of regulatory misconduct that may occur. So ideally, provide a unique perspective in addressing and hopefully preventing some of the government actions that are going to occur with regards to fraud in the time of COVID. So today what I want to do is talk to you briefly about a few things. One being just a brief background on the problem itself. What is it that is causing all the government enforcement actions? Secondly would be to explain the government's general priorities in combating COVID-19 fraud. And then I want to dive into a couple of key issues that are likely going to be relevant to the folks here in the audience today. So if we can go to the next slide, please, we'll just jump right into it. So the big thing here is that, of course, because of COVID-19, businesses across all industries and of all sizes as well, small businesses, medium, large multinationals are all feeling some sort of pressure due to what's going on in the economy. This goes for businesses involved in the supply of, key products like PPE, as Vik mentioned, and other medical supplies, even food delivery industry, and so on. And they've, of course, seen revenue dry up due to lockdown and social distancing. And that's, again, across the board, regardless of industry. And so because of this pressure, companies and small businesses, of course, can start becoming a little desperate with regards to trying to come up with a way to respond to how to have their business survive. And that's when, unfortunately, a lot of the illegalities, intentionally or not, come into play. Companies and other individuals and businesses should understand that some of the responses can lead to illegal agreements with competitors, decisions on how to deal with employees and employers, and of course on prices. And so one important thing to note is that regardless of where we are in a time of crisis right now, it is still illegal to agree with competitors on pricing, on inventory, on who to sell to, on market share, on when to sell, all sorts of sort of market related issues. Separate from that, of course, the use and the obtaining of the PPP loan is something that is going to be heavily scrutinized as well by various agencies within the government, which I'll get into in a bit. And so, with these laws still fully in place and a few others that have been more heavily enforced now because of the government's laser eye focus on this, the penalties are severe. You're looking at civil fines, looking at private lawsuits, looking at potentially, depending on what statutes used, you're looking at having to pay back 3 times as much as you earned based on what you've obtained through the potential fraud. And even at times you're looking at maybe even up to 10 years in jail if you have a certain price fixing issue or so on. So as a result, the Department of Justice, has repeatedly through Attorney General Barr made repeated statements during this pandemic, it's not going to tolerate anti-competitive conduct, other fraudulent conduct, other false claims type conduct, and actually instituted and established a particular task force to combat pandemic fraud or COVID-19 fraud within the Department of Justice. And what's important for, I think, some of the folks on the audience here is that although it's a national COVID-19 task force, it is headquartered here in New Jersey. Craig Carpenter, who is the U.S. Attorney for the District of New Jersey, is the head of the task force, the Price Gouging and Hoarding Task Force, and working with State Attorney General Rippi Karda from New Jersey as well. They are in charge of the nationwide COVID-19 task force. So it's important to understand that although it is nationwide, a lot of the focus naturally is going to be within the tri-state area here. Excuse me. Next slide, please. So with that, even recently, as end of March, beginning of April, right around the last couple of months, the Department of Justice has started bringing these cases in order to prevent hoarding, prevent price gouging, making sure that important equipment like PPE and other medical supplies are making it to the consumers and to the folks on the front line. As recently as I think March 30th in Brooklyn, as well as in Long Island, the FBI took in, arrested a few folks because they were hoarding and selling scarce medical supplies, including N95 masks, and they were selling them for almost a markup of about 700%. On the flip side, when it comes to the private lawsuits, 3M, one of the largest manufacturers of N95 masks, they have actually been going out and suing distributors or people or companies claiming to be authorized distributors of their N95 masks and suing them in court. And, for example, I think, just 2 weeks ago or so, they filed a lawsuit against a supposed authorized reseller for selling product at 500% markup. And something, another example close to home for me, I live in Jersey City. Up the street from me is a dollar store, and they were price gouging, raising prices on hand sanitizer, 20, 30%. And I remember police officers went in there, and it's a $10,000 fine per violation. They got hit with $90,000 within the span of 5 minutes. And so it's real. The problem is there, and businesses large and small are in the crosshairs. And I guess with the second bullet point here on the slide, with DOJ's oversight mechanisms, now or just the government's oversight mechanisms, the CARES Act institutes and creates a special inspector general for the pandemic relief and 2 other congressional committees to look into, alongside other government agencies, to look into the use of and obtaining of the money from the PPP loans. And, I will get into that a little bit later, but I think one thing I want to note that goes back to what Sandeep had mentioned is, if you have received $2 million or above, you're automatically by the Treasury Department, by the SBA, going to be reviewed, to see if your certifications were on the up and up and the use of the money is on the up and up, just to make sure that there is no potential false claims being had here. Now, that's the Department of Treasury issue that is still different from the Department of Justice, meaning if it's less than $2 million, the DOJ can still, for a criminal purpose, take a look at you, review you for, if you have $500,000, $200,000 in PPP loans. Just as recently, I think as May 5th, there was a big case from the Department of Justice up in Rhode Island, I want to say, where somebody or a few folks had gathered to collect $500 million in fraudulent PPP loans. And through a local police tip, they were identified as not having any employees working at all. And they just made fraudulent claims to the government in order to obtain this money. So the priorities are there. The government is looking into this, creating task forces designated for this, and working side by side with other agencies in order to combat fraud. So next slide, please. We'll go into now a little bit of detail into some of the issues that might be directly relevant to some of you. So the big thing here is price gouging. And the big point of price gouging is that which is different from price fixing, which I'll talk about in a second. Price gouging, of course, is a great public concern when it's a situation like this, when you have some sort of disaster or a crisis situation, because typically businesses are allowed and allocated broad freedom over the prices they charge for their products to an extent. But price gouging laws curtail that freedom. They bring it in during emergencies and set price caps on essential products during an emergency. In this case, although Attorney General Barr has not really come out with what's considered an essential product, HHS, Department of Health and Human Services, has indeed done so. Things like ventilators, disinfectants, PPE, some other general medical supplies that may be necessary for combating COVID-19 now and helping out the folks on the front lines. All of those items, hand sanitizer, will all be considered these sort of essential products, and the price gouging laws do apply. Now, normally you see these types of price gouging issues after hurricanes, like Hurricane Katrina, for example, and then pricing issues are related to increased gas prices. But of course, in this case, you have this new type of scenario where a lot more businesses, a lot wider group of industries are going to be impacted by the price gouging laws, more so than I've ever seen before. And I guess the difference here between price gouging and price fixing is, with price fixing, you hear it all the time these days with President Trump, no collusion, no collusion, no agreements, don't, avoid communications with competitors to set prices, to set market share, to share competitively sensitive information. And that's where you get with price fixing. The price gouging is on your own. It's something that a company or a business will do on its own. And although there is no specific federal price gouging law, we're seeing an unprecedented level of concern at the federal level. And with the Defense Production Act now implicated by the president, price gouging issues do fall into the purview of the federal government as well as the states. We have 38 states right now that have price gouging laws, including New Jersey, New York, Washington, D.C., for example. And with these laws, you see that they do vary quite a bit. But what's really important to note is that states like New Jersey, for example, have a 10% cap. That's how much you can raise prices before it becomes violative of the law. Other states have sort of a reasonable discretion type standard, which is fluid. But if you take all the other states into account, you can see that generally speaking, 10% is a good gauge for businesses to adhere to. And so that's sort of the price gouging issue there. 10% is a nice threshold to take into account. The feds, though, however, do have the authority now beyond the states to look into this and to investigate. Next slide, please.
Actually, before we go to the next one, or as we're going into this one, Sunny, if I can interrupt you for a second, we keep hearing about the Inspector General being appointed to oversee the CARES Act distribution of funds. How does an Inspector General differ from a traditional government investigation, and what are the key risks to watch out for? If you can cover that as you talk about your next slide, that'd be great.
Sure. So an Inspector General, there's particular statutes that do authorize an Inspector General. All federal agencies have one. I've worked with the Department of Defense Inspector General's office in my past life. And they're generally speaking, excuse me, tasked with, investigating fraud, waste, and abuse. And so now in this case, we have a special Inspector General appointed for pandemic review. And unlike normal traditional prosecutorial entities like the Department of Justice, like a state attorney general's office, Manhattan DA, where their focus, they may have individual task forces focused on this particular issue. In our case here, the Inspector General's office or Inspector General is keyed in to only this particular issue. Statutorily, his office or her office is going to be permitted to investigate for the next 5 years anything that has to do with the use of the CARES Act funds and obtaining of the CARES Act funds. They have subpoena authority to subpoena documents and compel that. They do not have, unlike the traditional law enforcement agencies, they do not have the ability to compel testimony. However, they can, of course, request it. And for the most part, it makes sense to actually adhere to those requests if you do get a request. And importantly, though, no matter what happens, the Inspector General still has the ability to refer any case over to the Department of Justice if they deem that there is a particular criminal violation that is happening here. So it's almost like the Inspector General has more focus, equal amount of teeth, and it's another avenue for the government to come at you. Department of Justice one way, maybe state attorney general another way, and now you have the Inspector General a third way as well. So with that, I think that answers your question.
Yes, thank you.
So now with this slide, I guess the point is with regards to everything that has to do with price fixing and gouging, what do you do? How can you prevent the problem? Price fixing is pretty easy. Just the idea is to determine your prices independently. Don't discuss with future prices or price setting with competitors, and I think you're pretty well set. With regards to price gouging, you have a few things here, avoiding being opportunistic, knowing what you can and can't do. But I think the best is point number 3 on the slide here, which is documenting the reasons for price increase. Now, nearly all of price gouging laws have some sort of exception where a seller can prove that if a seller can prove that a price increase is proportionate to the increase in cost, then you should be okay. And so the safest route here is to refocus yourself on the costs of input to then build it in your typical profit margin. And so if you do that, even though let's say you're 25% up, but your costs have gone up 22%, you're still okay, only if you can document those changes. And so I think it's important to make sure you have all that in writing, have all the documentation there, because the point here I think is, fine, you may not get in trouble if the government comes knocking, but the problem is the government might still come knocking. And that's a hassle in and of itself. A small investigation can take a month or 2 and cost you, lawyers' fees and so on. A bigger one can be over 12 months, and it's something you don't need. Reputational harm to your business, harms, maybe your customer base goes away. All these intangibles then come into play that you don't want to have happen. So the fastest way to prevent or even try to throw off an investigation is just to have the documentation in hand that you can, of course, protect yourself. And the good thing is, though, with regards to what's going on right now with COVID-19, a lot of federal agencies have recognized the problem, that sometimes there is a potential for some sort of collaboration in order to fight the crisis. And so, the Federal Trade Commission and the Department of Justice have put out joint statements stating that, normally a business can actually seek advice from the government, from the DOJ, from the FTC, saying, I'm about to do X, Y, or Z in terms of pricing, in terms of working with a competitor. Is this okay? Can I do it, or am I going to be violating the law? This program, the government usually takes a few months to respond. As of the end of March, the government has come back saying that they will expedite all reviews within 7 days. So if there's a business that has a question, has an issue, and thinks that collaborating with someone may actually prove beneficial overall, it's a good avenue to try to get in there with the government and get that response and get the sort of the comfort that you might need. And some of the collaborations that are unlikely to be problematic would be related to, of course, things involving the medical field, research and development collaborations, patient management decisions, joint purchasing agreements with regards to healthcare providers, distributing medical supplies, things of that nature. So go to the next slide, please. Actually, I want to switch gears a little bit here now. This actually, this is a no poach issue. It's something that I think has become a bigger deal these days because of COVID-19, and ties into labor markets, labor law, employment law that Vik was talking about earlier. And the history here is that as of 2016, again, Department of Justice and the Federal Trade Commission, they issued joint guidance for human resources professionals, and that hiring practices will have to comply with the competition laws, making sure that you don't have a no poach agreement with your competitors. What that means is, no agreements with each other to not hire somebody, no agreements to not cold call or to not solicit, even agreements to notify other companies before you court each other's employees can be considered a risky maneuver these days because the government is looking and has been looking. Now, there may be some pro-competitive reasons to do it, and those are, of course, exceptions in the law. But, historically, companies that have a tight labor market are the ones that are most prone to no-poach agreements. But with COVID-19, the definition of what industry has a tight labor market has now just broadened. So companies may include, or businesses may include, healthcare providers, telecommunications, online retail shops, all of these sort of traditionally non quote unquote tight labor market industries are now becoming there. And with COVID-19 and with regard to, making agreements regarding sick time and hours worked by employees, all of these sorts of agreements with each other can lead to, again, an investigation or just an inquiry from the government, which, a company may not necessarily need. So it's important to note that these days, due to what's going on with COVID-19. Next slide, please. So now I want to get into issues regarding the PPP loan. If you're claiming money, seeking a loan, what are some of the enforcement tools the government has handy? And this is what I was going at before, is that the Department of Justice has the False Claims Act. Now, as I said before, as Sandeep mentioned too, if you're $2 million or above, the Treasury will be looking at you, conducting a review. But regardless of the amount of money, the Department of Justice still has the ability to look into you, to determine why you took the money, for what reason. And that can be determined through maybe tips, through whistleblowers. The False Claims Act actually has a very stringent and solid whistleblower protection program built in. So you have whistleblowers, employees who might want to, quote unquote, rat on an employer for misusing or misobtaining some money. And of course, for very large entities and large multinationals, the government may introduce an affirmative investigation into a company. And so the False Claims Act is important because it is a civil tool and a criminal tool. And you have civil fines, you have criminal penalties, you have potential jail time. And generally speaking, what this is an act that criminalizes, or at least makes you liable if person or an entity makes a false claim or some sort of false statement in order to obtain money from the government. And this traditionally has been reserved for healthcare fraud, like defrauding Medicare, Medicaid, government contracting fraud, where there's companies making bids to the government in order to obtain money in a contract. Now, this, of course, has gotten broader and broader these days, especially with regards to CARES Act and the PPP loan. The issues here would be based on anyone receiving funds from the government under the CARES Act. And it allows the government to recover, of course, criminal penalties, civil penalties, and as I mentioned earlier, treble damages, which is basically 3 times as much money as you've gotten from the government, and also down the line, which would include money that you then were able to earn because you got the PPP loan. All of that amount can be encompassed. It can lead to a lot of damages for an individual or for a company. Next slide, please. And so the way the government identifies whether a false claims has been put forth, there are the certifications regarding the need for money, certifications of employees being paid, being rehired, other certifications that may have been made in order to justify how the money is being repaid, the 75% versus 25%, how it's all being allocated. There are issues where there are employees who might be making more money with unemployment and don't want to come back to work, but maybe they write a letter to the employer stating this, and the employer, there might be some underlying agreement between employer and employee so that the employer can still get the money and the employee can still collect unemployment. And all of these issues are going to be, sort of swallowed up under the umbrella of the False Claims Act. So it's a very important and very strict tool the government does have. And I think going back, Rippi, to your question about the Inspector General, this is what the Inspector General will do, or part of it at least. Again, as I mentioned, the IG can issue subpoenas for documents, request testimony, and look into the use of and obtaining of the money. And this is similar to how things happened after Katrina, when they had Katrina relief, and even after the 2008 financial crisis, when the TARP program was instituted, because we had a special Inspector General to manage the TARP program. And that was back in 2008 and is still ongoing. The Inspector General is still investigating, still issuing, starting cases and investigations based on the money and the use of the money even going forward today. So I guess luckily for our businesses, the Pandemic Relief Inspector General is only around for 5 years now. Is going to be around for 5 years. So there is an end date in sight, but in those 5 years, you're going to see a lot, I think, coming out in terms of PPP loan investigations. And that is pretty much all I have. There's one more slide, but I think I covered that already.
Well, then, can I just ask a quick question? I know we've kept our audience a lot longer than we were initially wanting to, but the information covered here obviously is extremely substantive, and we are only giving an overview, wanting to just educate the general public. But I do have a quick question for you. So as a smaller or mid-sized business, what steps can a company take now to protect itself in the event that the government does make an inquiry later on?
So I think the first thing to understand is that when a government agency, whether it's federal or state, comes in and makes an inquiry. When I say inquiry, I mean it could be an informal call seeking information, it could be a subpoena, it could be a grand jury subpoena, it could be an execution of a search warrant. And I have been involved in all of those, defense side and on the government side. And each of those things are escalating, of course, in terms of severity and urgency. But no matter what happens, any inquiry from the government is never going to be what you see on its face. There's always something underlying it, whether it's a particular witness they may have, some information they have that you don't know they have, other whistleblowers, or it might be that you're a small part of a much larger investigation. You just don't know. So I think the first step is, I think, having a plan even now, even for a small grocery store or a shop, to have a plan. If you get a government inquiry, what do you do right away? Like, you want it to be muscle memory. You want to know, okay, I have a little 3x5 card. Got to call the lawyer. I got to tell them what's going on. I got to ask the government, don't talk to me until I speak to my lawyer. And going forward, here's my lawyer. Don't talk to me anymore, government. That's the first thing to do, no matter what. Take all the information you can with regards to the inquiry, subpoena, get a copy of the document, search warrant, get a copy of the document, call the lawyer. And then, then at that point, you work with your lawyer to identify exactly what is really going on here. They may say on its face of the subpoena, they're looking for all documents with regards to securing a $200,000 PPP loan. But what does that really mean, right? And so that's one step. But then separately, just sort of hopefully trying to prevent anything or ward off an investigation. Like I said before, document everything. If you have emails, text messages, save it all, document it, don't delete anything. Try not to collude. Don't work with your competitors to fix prices and supply. And don't try to respond on your own, because the government's going to scrutinize your employee count, your employee dates, your payroll disclosures. And I think any response to an inquiry or even a preventative review to be done of your paperwork before a government inquiry happens, I think are both really key.
All right, so that was great. I want to just go through quick, if there's nothing else from our presenters, I'd love to, and here's everybody's information, please do note it for our audience. Feel free to reach out to folks afterwards. Some of the questions that have been asked in the question answer section are very specific, so I think it might be best to speak to the individual that you want to speak to from the panel directly. But if I could just have some lightning round type answers from our wonderful panelists. We have a question from a viewer that's asking, what if an employee is sick and is able to work from home? Do you handle that as an employer as a work day or a sick day?
So if they're able to work from home and they're doing their essential functions of their job, it's a work day.
Okay, fantastic. And with sick hours paid to increase payroll costs, can those be from the accrual period prior to the 8-week period? If the sick hours were accrued from prior to the 8-week period, can they be paid out to increase the payroll costs? I think that's more for Sandeep or...
Yeah, that's a tough question. I think that requires a more in-depth analysis depending on the pay period and what they elect in terms of the cover period that they're electing. But you can ramp up and maximize and pay those sick hours out, but it should be in the ordinary course of business. I don't think there's a direct answer for that, but it should just be in the ordinary course and not stray too much away from your ordinary payroll practices.
Okay. Okay, thank you. And if payroll is due on the day that an employer receives the funds, can they use the PPP funds to pay the employees?
Yes, but that just would mean your cover period would commence on that same day, so they align.
Okay. Understood. And I don't think we have any other questions at this time. I do want to thank PCC, AICC, and all the sponsors, and SALDEF, of course, Karen Gill for moderating our panel, helping to moderate the panel as well, and our esteemed panelists, Sandeep, Chandi, Sunny, Carpenter, and Vik Jaitly, thank you so much for sharing your insights. You've all been extremely helpful today, and we look forward to hearing from the audience members that might need more follow-up. We'll look forward to hearing from you offsite.
Great. Thank you.
Thank you.
Thank you, everyone.
Thank you for joining us.
Thank you.